Hello options traders, welcome everyone. It's been a while here since I've posted a video and I apologize for the delay. I was in Vegas, as many of you know, for a conference, and it reminded me of an interesting topic because this was no exception. Every time I talk about fair value, somebody will come up after the presentation and say, you know what, there is a strategy that will overcome this negative edge. Oh yeah, what's that? Well, it's called a martingale. And I hear this all the time, and I think it's an important topic for people to understand that if you have a negative edge in your option strategies, that nothing is going to help you to overcome it. And so let's take a look again as a little review of fair value, and then we'll take a look at why a martingale won't even save you. So first of all, remember that fair value is a financial concept. And it's just very simply the price where neither the buyer or the seller is expected to win in the long run. That's the key. Anybody can win in the short run, they can even buck the odds, but in the long run, they're expected to just break even. In other words, the bet is fair. And every single asset has a fair value. Stocks, futures contracts, CDOs, CMOs, and even options. And it makes sense because, let's say, if the buyers typically won, nobody would want to be the seller, and you'd have no market. And conversely, if the sellers always won, which is a myth that a lot of options traders believe, then you'd have no buyers, and the market would just break down. So there has to be a price in there somewhere that is considered fair to both parties, and that is sometimes called the theoretical value. Of course, in real-world trading, we have to compare that to the implied volatility and see what the market is willing to pay for that. But it all comes back to this concept of understanding what is fair for that option. So why is this important? Well, let's take a look at a simple example. Let's say we're going to do a coin tossing game. I'm going to pay you $1 every time it lands heads, and you pay me $1 every time it lands tails. This is a fairly valued bet. Coin has 1-to-1 odds. We're paying 1-to-1, and we're expected to win and lose equal amounts in the long run. So let's run this through Excel 1,000 different times in a simulation, and here's what we got. So what we're looking at here are the number of tosses down here, again 1,000 times that we played. This zero line right here in red means that we have zero profits or losses. So you can see this blue line after maybe 100 tosses down here. One of us was up maybe $7-8 through here. Down here after about 400 tosses, one of us got up about $15. At a later point, down after about 700 tosses, down almost $20, back up to almost 15. But if you sit there long enough, you will always come back to zero. You're just trending sideways. That is always what a fairly valued game looks like. On the other hand, let's say you were able to get this bet for less than fair value. I pay you $1 every time it lands heads, but instead you only pay me 90 cents. Now you have a 10-cent edge, and this is what the simulation would look like. Notice that even though you do have an edge, there were still some times in the short run where you ended up on the losing side. But in the long run, you will definitely end up on the winning side if you are paying less than fair value. And as you can imagine, we get the opposite effect if you pay more than fair value. So again, I pay you $1 every time it lands heads, and you pay me $1.10 when it lands tails. Now this is what you're going to look like. As before, can you beat the odds in the short run? Yeah, you could still end up on the winning side here. In fact, you got up about $15, $16 here, but if you sit there long enough, you will absolutely, positively be on the losing side of the deal. Now let's take a look at a little more complicated example, and I like using this for a couple of reasons. First of all, it shows why casinos will end up making money in the long run, even though to some traders it appears that they're giving very favorable payouts. You hear this a lot from options traders, and they'll say, well, I only do strategies where I can win 3-to-1 or 4-to-1, what they call their risk-reward ratios, as if somehow that gives them an edge. Their mistake is that they're not accounting for the probabilities of those. They're assuming they've got an equal chance of winning $4 or losing $1, which just isn't going to happen. So according to these traders, if you go to Vegas, you can do what's called a single number bet at a roulette wheel, and they'll pay you 35-to-1. That appears to be a favorable risk-reward payoff. You can also do a 2-number bet. You're going to just place your chip right between two adjacent numbers. They'll pay you 17 to 1. There are many kinds of bets you can place at roulette. This isn't all of them, but it just gives you an idea. But we can go all the way down just to a simple red-black bet, which pays off 1 to 1. So again, a lot of traders would look at this and say, 1 to 1 strategy, that's not real good. Let's do this one for 5 to 1, or this one for 35 to 1. That's better. They're not accounting for fair value. So what's going to happen here if we choose one of these bets? Well, here's the way that the math works out. Let's take a look at the single number bet. There's 38 spaces on the wheel, so you have a 1 in 38 chance of winning $35. And if you have a 1 in 38 chance of winning, you must have a 37 out of 38 chance of losing your dollar. So we multiply these together, we add them up, and we end up with a number. And we could do the same thing with the 2-number bet, the 3-number bet, all the way through the list, and guess what we get? Minus 0.0526. And what this means is that on average, you're losing about 5.25 cents every single spin of the wheel. So imagine this. You're sitting at roulette betting $1 all night long, and your friend is standing next to you, flipping a nickel into the trash can every time you spin the wheel. Mathematically, you're doing exactly the same thing. This is what it means to have a negative edge, even though you appear to have very favorable odds. Now, there is one other bet at roulette that you need to understand called the 5-number bet. It actually has about an 8-cent edge against it. So as I always tell traders, if you're going to be in Vegas betting at roulette, there's only one strategy you need to know. Just avoid the 5-number bet, and you're going to lose your money equally fast. Now, to also show this in another way, here's a guaranteed winning strategy at roulette. Walk up to the board with $38 in your pocket, lay $1 on each number. So you're going to spend $38. You're guaranteed to win. So you're going to get the $35 prize, plus you get your dollar back. You don't lose the dollar for the number that you won on. So you're going to collect $36. So you walk out of the casino with only $36. So you walk out losing 2 of your $38, and there it is again, 5.25%. You just can't avoid it. But wait. What about the Martingale? What is a Martingale? Well, it's a system of betting where you start off with an initial bet that equals the amount that you'd like to win. Whether it's $1, $100, $10,000, that is always the amount that you start with. So to keep it simple, let's say you want to walk away with $1. So we're going to start off betting $1. This is going to be on a red-black bet. So if we win, we will walk away with 2, and hey, we're up $1. But if we lose that bet, we now have to double it, and we will bet 2. And if we lose that bet, we will double it again to 4. If we lose that bet, we're going to double it again to 8. And this continues on the premise that you're not going to lose every single time. The wheel can't come up red every single spin. So let's say that you win after this bet right here. So you put $8 down. You collect $8 because it's a 1-to-1 bet, so you have now a total of $16 in your pocket. But take a look at what you spent up here. This adds up to 15. So if you win 16, but you spent 15, there you are. You're up $1, which is your initial bet. So again, the Martingale system says there's just no way that the wheel could continually come up red or always black, or that the coin could always come up heads or tails. Eventually, you have to win. Does that mean that you've overcome the edge? Well, let's take a look at how the math works out. I don't mean to scare people. I'm not going to get into all the details, but we're going to start out here with $2,047, which is enough to sustain 10 losses. And we could do the same thing for 15 or 20 or even 50 losses. It's just going to take more time. So the idea is we're going to assume that we're not going to lose 10 straight times. So again, this is a red-black bet at roulette. So if we start off winning on the first spin, in other words, we have 0 losses, we have bet $1, therefore our total bet is $1. We win $1 because it's a 1-to-1 bet, and therefore our total return is $1. There's about a 47.4% chance of this happening. So we have to look at what's called the expected bet. which is just the probability times the total amount that we bet. And then over here we have to look at what's called the expected return, which is the probability times the total return. So if we lose on this first spin, we drop down to the second row. It says we've now sustained one loss. What does the Martingale say to do now? It says we have to double our bet. We initially bet $1, now we have to bet 2. The total amount that we've bet right here is 3. That's just these two numbers added up. And if we win this spin, we've bet 2, we collect 2, we've spent 3, we have a total return of $1. Again, that's always going to be true. That's the whole idea of the Martingale, is that we want to end up winning our initial bet. But the probability of this happening, in other words, losing on the first spin but winning on the second, is about 25%. We go through and calculate the expected bet and the expected return again. So we work through the numbers in a similar way all the way through, and then finally down here on the 10th spin, what we have to do is account for 2 different outcomes. If we're unlucky enough to have lost the first 9, on number 10 we either have to win, which is this row, or we have to lose, which is the second row. And then we sum up the probabilities right here, and as we all know, that has to sum up to 1, because you have to account for everything that could happen. And so we see that we have. Then we're going to look at this column here, the expected bet. And what we want to look at is the average. We're just going to add these numbers up, divide by 12, we get 1.2. And in this column, we are looking at the average of the expected returns. Add up all of these numbers, divide by 12, we get minus 0.063. So now think of it as almost like a return on your investment in finance. This is our return, or the expected return, minus 0.063, but it cost us as an expected bet of 1.2. So what's our return? It's minus 0.063 divided by 1.2, and guess what that gives us? There it is again, minus 0.0526, or about 5.25 cents. You cannot avoid the negative edge, even with a Martingale. So every time I hear somebody saying that a Martingale allows you to overcome the edge, it reminds me of the old business school joke of the shopkeeper that says he's going to sell everything at a loss, but make up for it in volume. It can't be done. And yet that's what traders are trying to do when they devise strategies, but they're not paying attention to fair value. So remember, when you're trading options and you're looking at a pricing model, let's say with these variables over here, and it says the model price is 236. What does that mean? That's the option's fair value. If you pay 236 for that option, you will just break even in the long run, not counting commissions. If you sell that option for 236 in the long run, you will just break even, not counting commissions. If you're not paying attention to this, no strategy is going to save you, not even a Martingale. For those who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and a brand new strategy lab for 2019 at optionsaToZ.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.